Our next guest on Toronto Boomers is a well-known investment advisor in Toronto and a passionate advocate for investor education. Warren MacKenzie was the founder of Way House Investor Services and has been advising clients for over 30 years.
Warren is also the author of 2 books, The Unbiased Advisor and The New Rules of Retirement. And Warren, let's focus on the title, The Unbiased Advisor. What do you mean by unbiased?
Well, it's a big problem in the industry in that there is a conflict of interest. When a person is selling an investment product, and if they earn more from selling one product than another, then there's a conflict of interest. So at the time I wrote that book, I was trying to, I wasn't working for, I was working on an hourly basis, so I had no conflicts.
Right. So
and it's a big problem that people don't realize that there's a conflict, and probably if they did, they would maybe have their guard up a little bit more. There'd be a little more questions.
Sure.
There's a tendency then to push the products for which you're going to make
yes,
it bigger.
I think there is.
Yeah.
Warren, our program is aimed at viewers, obviously, in the age group of 50 to 75 years of age. And in that 25-year spread, there's probably a pretty significant difference in their investment statuses, I guess, is the best way to put it. And I assume that an investment counselor or advisor like yourself would have different strategies for the 50-year-old versus the 75-year-old who's probably retired.
Well, they really should be following the same strategy, and I would say that the thing is, it's the investment process that's more important than the investment products. And everybody should be following the same investment process. I mean, they'll have a different asset mix, but they should be following a very disciplined process.
Let's focus on the older side of that spectrum, the investor who's retired, let's say, from making a steady income and perhaps has a pool of capital that he's saved up and perhaps capital in the property that he owns. How do you suggest that these people should approach managing their investments? Obviously, you talk about the process, but is there sort of a set strategy that you would apply to these folks?
I think you start by doing what you call a goals-based approach, and find out, and probably the best way is to have a financial plan that shows you what return is necessary for you to achieve all of your goals. And if the plan shows that you can achieve your goals with a 4% return, then you don't aim for a 6% return, because then you're taking on more risk. So I'd say you start by having a financial plan that shows you what return is necessary, and then take no more risk than is necessary.
Okay.
So the goals-based approach, I get that. A disciplined investment strategy. Disciplined meaning you stick to it, or disciplined in another sense?
No, disciplined in the when you buy and sell. And to give you a simple example, imagine that your target is to have half stocks and half bonds. And for the stocks, you know that they'll go up and down in value. So there's a range of, say, could fall as low as 40% or rise as high as 60%. So as long as your stocks are in that range, you do nothing, you just stick with it. But then if the markets are on a tear and you breach that upper range, if it's becomes 61% in stocks, then you rebalance. You sell them at the high price and bring it down to 50%.
So you stay within the band.
You stay within your band, and you're forced to sell or buy at the, selling high or buying low, and it takes the emotion out of it.
So is it your advisor that's going to help you be disciplined, or do you discipline yourself?
Well, I would say your advisor should help you with that. And if not, you do it yourself.
Right.
You also talk about the need for proper performance reports. What do you mean by proper?
Absolutely. It's one of the biggest problems in the industry. There's no other industry in the world where you pay your fees every month and you don't find out if you're getting any value. So you need a statement that shows you your rate of return and how that compares to the proper benchmark. It's not enough just to see a statement that shows that you made a little bit last month or you lost some. What should you have done? What did the market do? So you need a rate of return in a percentage and a benchmark to compare it to, and then you can tell if there's a problem, you can address it. But unfortunately, people will go for years without ever knowing whether or not their advisor is adding value.
Yeah.
And when they get that report, is it what, monthly or annually
Well,
or
I think
4
a
times
quarterly
year?
report
Quarterly.
that shows the performance compared to the benchmark would be sufficient. But there's not 1 in 100 investors that get a proper report that shows the rate of return compared to the proper benchmark.
Is that because they're not asking for it, or they're not asking the right questions?
Well, the industry doesn't encourage it. Yeah. It's not on the statements, and unfortunately, investors will receive their statement and they look at it and they think they should. They think there's enough information there that they're just not getting it. But in fact, there's just not enough information there.
In your book, and I know when we talked to you before this interview, you wanted to cover 3 other pieces of advice. One is keep it simple.
Yeah.
Secondly, pay attention to fees and costs. And third, ask your advisor for a detailed investment policy statement.
Right.
Briefly talk about those 3 items.
Yeah. Well, keeping it simple is obvious. And I'll just tell you a story. One of the best investments that I had seen, investment portfolios from a person who was doing it himself. It was a doctor. He had several $1 million, and he could have put it all on a yellow sticky. He had 5 different positions. They were all exchange-traded funds. It was a well-balanced portfolio. He knew to the second decimal point how much he had in the U.S. compared to Canada, and it was because it was simple. If it's complicated, you just can't rebalance. You don't know what you have, and you give up. So that's why you should keep it simple. In terms of the investment policy statement, that's like an agreement which allows you to hold your advisor accountable. It sets out this is going to be the asset mix, this is the range, this is how we will rebalance, these are the fees, this is how frequently we'll meet, everything that you need to hold your advisor accountable.
So on the fees, that's the second point. So we need to be more aware and be very explicit when we ask about what it costs.
Well, that's right. And you know, within the industry, a lot of fees are hidden. They're not immediately visible. And you know, 20 years ago, when we were expecting to make 20% returns and you were paying a 2% fee, well, okay, it was a lot, but it was only 20%.
Yeah, it's a small portion.
Now, if you're making 4 or 5% and you're still paying that 2% fee, now that's you know, 40 or 50% of your return.
Yeah, indeed.
So you have to ask for that, and I would say it should be in writing. And if you have an investment policy statement, it will be detailed clearly what the fees are.
So when it comes to retirement finances, are people generally, are they lazy or naive, or are they not paying enough attention to the things they should be? Because they get into trouble.
Yeah, I think they don't pay enough attention. They think it's more complicated than it is. If they simply asked for a performance report that shows the rate of return compared to the benchmark, then they would know if there's a problem and they could address it. Another thing that I would see from the retired people I work with is quite often they're taking on more risk than they should. There's no reason for a retired person, in my view, to be 100% in equities, and we see that quite often.
Warren, let's say I'm 65 years old and I've decided to retire now, and I think that with my RSP and perhaps the value of my house, I have enough money, and I've kind of planned to have enough money to live on for, say, 15 years. You know, my forebears never lived past 80, et cetera, et cetera. But with all the medical advances and lifestyle advances in the last 15, 20 years, I may live a lot longer than I planned. So what's my strategy to be? Is it to cut back on my lifestyle so that it lasts longer, or should I be taking more risk with my investments?
Well, it's a combination probably of those two. And the thing is, if it's a husband and wife, if it's a couple, statistically, one will probably live to about 95. Yeah. So when I do the planning, I usually plan to 100. You need a financial plan to show how is it going to work out, and then if it turns out that you're going to run out of money at age 80, then you address it. Then maybe you'll work longer. I'd rather see you work longer than take more risk. Yeah. Work longer, spend less, but if you have a plan, it will show you how things are going to work out, and then you can do whatever is right for you. You'll do the right thing if you have the right information.
So let's talk now about the 50-year-old viewer who's still got parents, aging parents that they're taking care of. They've got kids that they've got to put through school. They've got a lot of commitments on both ends of the spectrum. and they're not able to put away enough, really, to save for retirement, which they should be.
Not yet. Yeah.
Not yet. So should they be getting into riskier investment? Should they be more aggressive about retirement planning? What should they be doing?
Look, I talked to a person today who called me, and they had been convinced to put a $600,000 mortgage on their home and to invest, and they lost almost all of it.
Oh,
so taking more risk is not the answer. It's to it's to maybe spend less or just plan it out. And I think if you have a financial plan, you'll see the answers will come. What should you be doing?
Sure. We've got 15 seconds left. Are you optimistic about the state of the economy or the markets today? Very quickly.
Not really optimistic, but I think if you follow a disciplined program, you will be in the right asset mix forever.
That's the key. Well, that's great. That's very useful information, Warren.
Yeah.
Thank you. We'll
Yes.
probably have you back on again, too.
Yes.
So, thanks for being here tonight very much.
And thanks for your advice. And next up, advice on how to approach the whole concept of dating at our age after this break.